Welcome to your May Investor Update. I'm Max Ray, Head of Product here at Nutmeg. In line with current government guidance in the UK, the Nutmeg team is continuing to work remotely, and we are therefore filming our Investor Update via Zoom again this month. I'm joined virtually today by our Chief Investment Officer, James McManus. Hi, James.
Hi, Max.
James, despite record new coronavirus cases globally, April seemed to follow where March left off and was quite a positive month for financial markets. How did global stocks and bond markets perform during April?
Well, you're certainly right, Max, that April followed in March's footsteps with a strong monthly return both for global equities, but also many fixed income assets. Global stock markets rose just under 5% in local currency terms on the month, with developed markets outperforming their emerging market peers by over 3% in April. Emerging market stocks were offering investors returns of just 1.6% for the month. Now, leading developed market gains were US equity markets, a favored region in Nutmeg portfolios, US large cap stocks delivering around 4.5% for the month, and the growth-centric NASDAQ saw a month of outperformance up close to 6%, while smaller companies delivered returns closer to 2%. Elsewhere, it was really Japan that was the laggard in developed markets, giving back some of last month's strong outperformance with negative returns of negative 2.6%. But it was also a strong month for UK equity market returns. UK large caps delivering around 4.1%, whilst UK mid caps rose around 4.9%. In the bond markets, after a volatile first quarter, we've seen a much more muted month for government bond returns. UK gilts returning around 0.5%, while US Treasuries returned around 1% in April. It was also a relatively muted month for corporate bond returns in April, with returns around 0.8% for higher grade investment grade corporates and around 1% for higher yielding corporate bonds. So on the whole, a good month for equities and a relatively muted month for bond market returns.
Thanks, James. And what were the main drivers behind market movements in the month?
Well, rather than being driven by just one or two events in April, and despite record coronavirus cases globally, financial markets have largely been supported by a continued backdrop of stronger economic data. And as in previous months, we've continued to see an improving pictures in many aspects of the global economic complex. The global trade recovery continues to gather pace. There are really encouraging signs that investment cycles are beginning to pick up again too. Now, the all-important US economy is leading, showing signs of strength not just in its manufacturing sector, but also in the critical services sector and the labor market as confidence returns. And emerging market exports are also rising. The Chinese economy acting as an engine for regional growth in Asia. And on the back of that, commodity prices also have continued to drift higher, where we're seeing really robust demand. So April on the whole has really presented investors with another set of economic data that points firmly to a consolidating economic recovery. In addition, we've also bookended the month with two more significant stimulus packages in the United States, both the American Jobs Plan focused on infrastructure and the American Families Plan focused on social reforms, totaling approximately $4 trillion in fiscal spending and a staggering 20% of GDP. And if passed, those programs would become some of the largest and potentially most transformational economic programs that have been enacted in US history. Now, importantly for investors, after a volatile start to 2021, government bond markets have taken much of that news in their stride. And that could be because the programs are yet to pass through the formal approval process, but also much of this additional spending is proposed this time around to be covered by tax rises rather than government balance sheets. And with central banks remaining at odds to stress their no rush to normalize policy, financial markets are really reacting positively to this Goldilocks combination of supportive central bank policy, further economic stimulus, and a strengthening economic recovery.
Against that market backdrop, how did the Nutmeg fully managed portfolios perform during April?
Well, as we've already covered, April was a good month for both equity and fixed income assets on the whole, which means it was also a strong month for portfolio returns. So in the month of April, fully managed portfolios delivered returns of around 0.95% in our lowest risk portfolios, through to around 3.7% in our highest risk portfolios. Now, returns in our socially responsible portfolios were slightly lower than that, around 0.9 in the lowest risk, through to around 3.2% in the highest risk socially responsible portfolios.
Given everything that's happened lately, have you made any changes to the Nutmeg fully managed portfolios?
We made some small adjustments during the month of April. Firstly, at the beginning of the month, we exited our holdings in US mortgage-backed securities in our lower and medium risk portfolios. Now, the spread or premium, if you like, that an investor gains for holding mortgage-backed securities over US government bond assets had reduced to its lowest point since 2010. And that really reduced the attractiveness of those assets relative to US government bonds. And so with that additional return source eroded, we moved back to government bond holdings with those positions. At the same time, in our higher risk portfolios, we took advantage of the recent underperformance of US smaller cap stocks to marginally increase our weighting there, given that we expect them to continue to benefit in the coming months from a continued economic recovery, particularly in cyclical and services-linked sectors of the economy, and as US economic growth is turbocharged by those further stimulus programs. Finally, towards the end of April, as markets drifted higher, we did rebalance a little bit of our equity exposure to cash in order to manage our risk as our equity overweight grew across the portfolios.
There's been a raft of headlines on companies' earnings in the past couple of weeks. We're still in the middle of earnings season, but what do the results tell us so far?
That's right, Max. We're right in the middle of the first quarter earnings season. One of the most important in recent memory is investors assess how much of that positive macroeconomic story has fed through to company bottom lines in the previous 3 months. And ahead of this period, expectations were high, particularly in the US, where we've seen a record increase in earnings per share expectations. And the results that we've seen so far certainly justify that positivity. In the US stock market, the S&P 500, we've seen just over half of companies report earnings with an average earnings growth of around 50% and sales growth of over 11%. And what's more impressive is that's against that backdrop of strong expectations. So earnings growth has actually exceeded analysts' expectations by about 23%, and sales growth by a smaller but still positive 4%. So the picture emerging from corporate earnings in the world's largest economy is clearly a positive one as we move into the second quarter of the year. Now, in Europe, the earnings season is off to a slower start, but the results have been no less positive. We've seen around half of companies in the Euro Stoxx 50 report their earnings thus far, with earnings growth of close to 80%, a staggering 50% better than analyst expectations. And meanwhile, in the UK, we only have a portion of companies offering a quarterly update here, but the story is a little bit more mixed. Strong from an earnings perspective, disappointing from a sales perspective. But of course, UK investors will be watching earnings announcements very closely for impacts on dividend payments, with dividend payments from UK companies improving on 2020, but still expected to be significantly lower than they have historically been this year.
This month's customer question comes via Tom on social media, who asks, it seems that the US-China trade war is no longer in the headlines, but is this still an issue for financial markets?
Well, I think the state of US-China relations is certainly still an interesting topic for markets, and it's certainly still front of mind for investors, particularly as tariffs applied during that so-called trade war under the Trump administration are still very much in effect, but also because of the multiple dynamics to this competitive relationship. And in fact, we've discussed some of these dynamics in a lot more detail in a recent thought piece on Nutmegonomics that looks at the potential for the US and Chinese economies to decouple. But ahead of the US election in November last year, we stated our belief that the US would continue to take a hard line on China, albeit through more diplomatic approaches than the past administration. Clearly, there are topics that the two countries are willing publicly, at least, to work together on. The most recent example being their shared commitment to work on climate issues. But I think the emergence of China as the greatest competitive threat to the US, both economically and politically, means that we expect that relationship to remain a balancing act between accommodation and competing interests. But I think critically, the two nations also have much to benefit from a constructive coexistence. So despite that occasional adversarial rhetoric, we expect the relationship to evolve in coming years to one where both sides learn to live with each other for their own mutual benefit.
Thanks, James.
Thanks, Max.
Thank you for joining us. If you have any questions for James or the investment team, or something you'd like answered in next month's investor update, you can contact us via social media, email, or in the comments section below this video. We look forward to seeing you next month.